Hey traders, welcome back to this series of videos. We're talking about technical aspects of trading, specifically chart patterns. And in this video, I'm talking about the rising wedge and the falling wedge. What I'm going to do, I'm going to talk about the official definition. I'm going to talk about the way that I perceive it. We'll look at it on the whiteboard, we'll analyze it, we'll dig into it, not necessarily purely from a technical perspective, but also from a supply demand perspective, also from a perspective of what it means for you as a trader and how you can use this or not, or discard it and say, it's not for me, it's no good. As always with these things, guys, if you've got any comments about how you do use it, if you've got a little flavor or a little twist in a way that you use it a little bit differently, I love to hear those kind of comments if it's something that works for you, or if you think it's a completely useless pattern as well, leave a comment below. I will read them all. Let's talk about the rising wedge. Do you know what? I don't actually trade much of these, and maybe I look at it completely differently to an actual chart pattern, but it makes a lot of sense. So let's look at it. So the official definition, if we're using official for something like stock charts or Investopedia, is that the prior trend, there's got to be a trend before. It's a reversal pattern. It's over a 3 to 6 month period. You get an upper resistance line, a lower support line, a contraction, a support break, and there's volume. All right, I get it. Let's get on with it. So we've got this kind of thing. Now, I think the important thing to distinguish between this and perhaps a flag pattern is a flag is a very tight, short-term, aggressive pattern. A wedge is a more of a long-term, it's working itself out kind of thing. So we've got to drive up. We get this kind of pattern here. Hopefully I can do this. Now that's not the best wedge, but it will when I put these lines in. You will kind of see what we've got here. So we have this pattern here. Now they should all be pretty equal. If you look at some of the patterns, sometimes they're rising. Let's have a look what we got here and some of the things. You know, sometimes that's more like this. Sometimes it's a bit more flat. But the point is you have this kind of thing. You know, it's this uptrend, it's this narrowing, if you like, of the price. That's not the best drawing in the world, I will give you that. But if you go onto Google and look at some actual chart examples, you'll see. But here I want to just dissect it a little bit more closely. So the point is with the wedges, it's a reversal pattern, and it's a reversal going to the downside. So the theory is that you are looking for a break lower here. So it's pushing up, it's trying to do a lot of things, it's trying to get going, it's trying to really get some momentum behind it. It may well be rising as we've kind of had here. In fact, let's try to make this one a rising wedge if we can. Let's kill that off there. So it's rising, it's contracting, it's, you know, you've got an uptrend channel here, you've got an uptrend channel there. It's not symmetrical as such, it's coming to a pinnacle. But the point is that even though buyers are stepping up, and you've got those higher lows, higher lows, and maybe you've got higher highs, the point is that the sellers are, because it's narrowing like this as opposed to being symmetrical, the sellers are slightly more aggressive in terms of how quickly they're hitting it on the next push up. What do I mean by that? So there's your first push up. If they're hitting it again there, they are not waiting until it's much higher. They are thinking, this is value for me, I'm stepping in a little bit earlier. That then, you know, extrapolates out into this bit, this bit, this bit, and then eventually it gets to a point where the buyers haven't got any strength to push up anymore, or they run out of volume, whatever it may be, or vice versa. For that, we know we've got two sides to every trade. The sellers are perceiving it as great value, they think they're going to hit it, and you basically get all these people here who have been buying who are caught out because this thing then breaks lower. The idea is that you're selling a break of the wedge to the downside, and it's going to move lower and lower, and the stop is going to be above the upper end of the wedge. Now, some of these examples here are really quite broad, and one of them in particular, we're looking at the chart here of, I don't know what chart this is, but it's very tight, very aggressive move actually. I personally don't think this is actually a wedge. It's from stockcharts.com, so if they're the guys who are technical textbooks, we'll take their word on it. But they've kind of got this pattern where you've got to push up higher. I might put it on the screen in a second for you guys as well. You know, this kind of thing here. So they're saying that this is the wedge here, and then this is the fall of the wedge here. And they are actually saying as well that you should be selling it on the break of the last support. I'm a little bit dubious on that one. I don't think that's as good. I understand why they say that. I appreciate that that is the low point there, and they're saying that, you know, this is a reversal pattern, but for me it's a little bit arbitrary. What they are saying, which is actually quite good, is that if it comes back and retests that and rolls over, that's a good short point. I quite like that, because you've already, to me, this is a little bit messy. A little bit messy. You see the reversal here, but you could still have a push up higher. I think you could also, you could maybe say it's a head and shoulders pattern there as well. I think when you get the failure here, that's the time you probably want to have a little go at it. For me, that was the time I'd look at it and say, yeah, I quite like that, especially if it pushes up, fails, then rolls over. At least I can quantify my risk on it. So that's a rising wedge. A falling wedge is just, you know, vice versa. You've got the same kind of thing, flip it on its head, but it breaks the upside. The important thing is it's a reversal pattern. It's to see when, you know, the opposite side of the more aggressive mover decides enough is enough and steps in front of it. Now, the important thing with all these patterns is how they fit in relative to the rest of the price. If this has been an aggressive uptrend and you think it's had several counter trend moves and it's coming, that you potentially think it could be coming to the end of a trend, this may well be something to look for. The wedge, that kind of rounding, you know, rotational type pattern. If this is at the beginning of a breakout, you may want to be cautious of it, because it could be a continuation type pattern, and you may well be selling something that actually is just getting started. So you've got to put it in perspective. If it's had 1, 2, 3, 4 maybe cycles, you're in your 4th, 5th cycle, then perhaps it's something to look at. This is more of a long-term thing. This is over days, months, weeks, almost, or years. It's just looking at it in a bigger picture. And again, love to know your comments below on what you think about the wedge. Is it a bit of a rubbish pattern? Is it a decent pattern? Do you use it? Do you not use it? Do you call it something else? Or do you think this is just a little bit of people in the chart world trying to make an actual real, you know, framework around something that isn't really that good? Or do you think it's very, very good and should be used every time you see it? Would appreciate to know what your thoughts are on this. If you like this video, give it a thumbs up. If you want to subscribe, then you're going to get loads more videos about technical discipline, psychology and strategy from me over the next coming weeks and months. Take care.